Hey, everybody, welcome back to another episode of the Work Hard, Invest Harder podcast. I'm your host, Justin Dixon, and today we have Flint Jamison on the podcast. Super interesting. We talk a lot about mindset. We talk about his 20-year career as an aerospace engineer for Boeing, building aircraft. Talk about his first deal being a duplex, kind of a burr, but didn't exactly work out. We kind of unpack that a little bit. And then we talk about his shift from being in the kind of small multis, going up to more of the syndication world. And then we actually talk about build to rent communities, which is a thing that I've seen a lot in Austin and a lot of major cities. So we talk about investing in build to rent communities and the multiple exit strategies that come out of that. So really interesting podcast. So let's get Flint on the pod.
Do you love your job, but want other investment options than your company's 401k and trying to pick stocks? If so, you've come to the right place. In this podcast, you will get actionable information for your passive real estate investment journey. Welcome back to another episode of Work Hard, Invest Harder podcast. Here's your host, Justin Dixon.
All right, Flint, welcome to the podcast. Happy to have you on, man.
Thanks for having me, Justin.
Awesome. Well, I guess let's kick everything off real quick here. Give us and the audience kind of a little bit of an intro of you and kind of what you're up to in your life and in real estate, and then we'll unpack some other things.
Yeah. So I spent 20 years in aerospace as an engineer, mechanical engineer. I designed aircraft, particularly Boeing, the 787. Have you flown on one of those?
I'm sure I have. I try to not to look at the airplane's types because it's like the Max or whatever.
It's the famous one with the windows that you can dim with a button. There's no little
I don't think I've ever been on one of them.
Yeah. Okay, yeah, you got to get on one. It's a fascinating experience.
Yeah,
I'm biased because I designed the wings. In 2018, I got into real estate. I did a duplex. I burned it, buy, rehab, rent, refinance, repeat. We won't delve into that. It was semi-successful. I didn't lose money. I made money, but it wasn't a successful burr. From there, I realized doing these single-family homes or residential real estate wasn't going to get me to my financial goals very quickly. It was going to be a very long-term endeavor with lots of capital, managing everything myself. It just seemed like there could have been a better way. And then that's when I discovered syndications. You team up with people, you do big deals, apartment buildings, and then all sorts of new benefits come out of the woodworks from that, like the tax benefits. So economies of scale and working with other experts. So I've been doing that since, say, 2021. I've got about 1,500 units in my portfolio, both active and passive.
You said 1,500?
Yep.
Got it. So let's start with the first deal you did. You and I started our journeys in real estate the same way, a little bit differently though. We went with duplexes. I guess what caused you to jump into a 2-unit versus what a lot of people do is they know about the single family because they live in a house, right? So they typically start there. Why did you jump to the 2-unit?
Well, an opportunity presented itself that I could afford. And so from there, I knew that scaling was better, 2-unit, 3-unit, 4-unit, that would be better. But I was able to buy a distressed asset for $80K. I ended up using hard money to buy that $80K, then spending cash out of my pocket, another $30K to rehab. And after that, why I say it wasn't super successful, the cash out refi was not an option. They basically just refied me for the value that I created. So I ended up selling it a few years later. Actually, at the end, in the early 2022, at the peak of the market, I sold it right before things started going down. So I made money.
Brilliant. So when did you buy that? When did you start the whole journey?
I probably listened to podcasts for your pockets as most of us got started back in 2017. I bought that in mid 2018.
Got it. So you spent 20 years, you said, in aerospace engineering. And I guess at what point were you like, okay, I either like my job, make money, make good money, but I want to figure out other ways to invest, or like what was the shift? Because there's a lot of mindset stuff that we can talk about. There's a lot of just
yes.
there's just like I need more money kind of thing. So what made the pivot of like, okay, in 2017 you said you started kind of researching. So how did that turned on?
Man, the mindset thing is just like a year's worth of journey. We could just delve right into that. Back in 2017, I was fed up with the stock market because my 401s, all my personal investments, they were all mediocre. And you had always heard of like somebody's rich uncle who, well, rich dad, poor dad, but you've heard of people that are just own a portfolio of real estate. They live off of that passive income. They work for themselves. And I was super burnt out with my job. As sexy as being an aircraft engineering is, the daily grind can be a lot of hours. I mean, welcome to being an engineer. You grind away a ton of hours. You're hoping for better than 3% raise every year, then maybe a promotion in 5 years. And it's a grind to really build wealth. And I knew that real estate was probably a better way to grow wealth.
Got it. And so you thought about, okay, what was the first book or kind of podcast, or maybe it was Rich Dad Poor Dad that kind of was like, that really lit the fire? Because a lot of people think about like, hey, I want to make more money, or I want to think of other options to invest, right? Other than the stock market or your 401k. But you can kind of fall into this analysis paralysis phase of looking at a lot of different things and then not taking action because life happens and you get busy in other things. So like, how did you stick to that next thing was I need to figure this real estate thing out?
I found it quite easy. I was walking my dog every night and I just happened to discover bigger pockets. And it just night after night after night, I was just digesting bigger pockets, and it was easy because I needed something to listen to.
Yeah.
And that constant beating of there's people doing this and they are average Joes. So why can't I figure this out?
Yeah.
I ended up, and then I was presented an opportunity to buy this particular duplex. But my mindset transition after that, once you get into the syndication space and you start getting coaches, and all of a sudden my whole world just blows up into something completely new. And it's totally converted my life into what I was originally thinking as, yeah, I'm going to own some single family homes. Now it's like, it's opened up a world where I think differently. I'm more positive. It's allowed me to spend more time with my kids. It's grown my wealth a lot more than if I were to just stick with my day job. So it's been way more than just a wealth generation. It's created a community and a new mindset for myself.
Yeah, and I want to kind of unpack a little bit about that, because I think, I had a light bulb moment with Rich Dad Poor Dad. I read it as I was walking to and from work every day. And, that was literally just like I need to change what I'm investing in, where I'm investing my time and energy and all of that. And it sounds like you had a similar kind of manifestation, if you will, as you're walking your dog, listening to bigger pockets. How did you kind of land on the 2 unit? It sounds like you kind of were, almost kind of fell into that one. So I always like to kind of learn about the person's first deal, because that's always sometimes the scariest, right? Because you've maybe never done real estate before, or you don't. I didn't know anybody that was kind of doing this stuff, right? Even buying a duplex. So how did that first one go? It's, obviously we talked about the ending. The front end of it work.
It's interesting. I actually don't remember how I got connected. There was an individual, because part of the whole the Burke strategy, you got to build your team around you. You get the GCs in place, the realtors, etc. I was just starting to think about, where do I want to buy, and I was thinking in my backyard. It's the easiest, and I was living in Denver. Denver's a great market. It costs a lot though, so it'd be maybe hard to find a deal. I came across this thing where this guy was offering like a one-stop service where he was essentially playing the realtor role plus the GC. So they would actually, and they were essentially a wholesaler. So they'd go find these distressed assets. They were able to purchase them, put all the systems in place. They would have basically presented me a deal. Here's how much it's going to cost you. Buy it for this much. Here's what the renovation is going to cost. Then we will we'll help you with your insurance and property manager. And they were doing economies of scale for this. And they would basically bring in investors who wanted to do the Burr strategy, but with like a turnkey service.
Yeah.
But that's how it got presented. That particular person is no longer doing it, but I think that it made an easy stepping stone for me.
Yeah, it's interesting you bring up turnkey. I've talked to a few people that had no idea that I was in real estate until I started posting on LinkedIn and things like that. And then, we strike up conversations, and that was their first kind of venture into real estate, was these turnkey solutions that they were doing single family in like Tennessee or Indiana or something like that. And so it is an easy button, if you will, to kind of dipping your toes in the water. Because essentially some of these things are just like, you literally just buy the property. It's already got a tenant in it, and they're going to take it over and you just collect cash. So it sounds like it's a little bit more involved than that.
Yeah, it was like a turnkey Burr offer versus the true turnkey property that's, you just might need some paint. Let it go.
Got it. So after kind of the duplex, then you were like, I need to go bigger, right? And it sounds like you kind of just went right from the 2-unit into the syndication, which in of itself is a big leap. And, another mindset kind of stepping stone, if you will, to kind of, keep leveling up. So I want to dig into that. But before we do that, I want to take a quick sponsor break. So we'll be right back.
Whether you're in a job you love or hate, building a financial foundation is important. This foundation can support you by providing passive income, stability in an uncertain economy, or the launching pad for you to start your own business. Great Venture Capital helps busy professionals invest in commercial real estate to build passive income streams, grow wealth, and take advantage of tax benefits. If you'd like to learn more, check us out at greatventurecapital.com or send an email to justin@greatventurecapital.com.
All right, we are back on the Work Hard, Invest Harder podcast with Flint Jamison. We started out talking about kind of your first deal, duplex / Burr, and now we're going to move over into the big stuff, the syndication world. So how did you decide that was the next evolution that you wanted to go into, and how did you kind of start that whole journey? Because it's a lot more difficult to underwrite a 150 unit deal than a 2-unit deal, right?
Yeah.
So maybe step us through like that process and how you got
it. So it's a lot of similar process. I mean, I once again walking my dog, I discovered this new podcast of syndication. Totally dove into that, and then once I felt comfortable with what it was, that's where then I found a coach, because then you got to figure out how to underwrite. You get the model. You start finding team members to work with. And then, I mean, long story short, that was it. And my first property was a 23 unit in just outside of Denver. I was the only boots on the ground. That one did not pan out. We got in, earnest money in, due diligence inspection. We ended up having to back it out for a multitude of reasons.
Got it.
I ended up losing earnest money on that. So I got a lot of school of hard knocks there.
Yeah.
But out of that was you never quit, right? Okay, so here's a mindset. That hurt. That hurt a lot. I put a lot of money and energy into that. And I honestly use that as a springboard. It was, they sometimes say as soon as you have your first deal, you skyrocket. Well, or the law of the first deal, as they call it.
Right.
I call it the law of the half deal, because it gave me a lot of credibility from, I did this and we backed out. We made the right decisions. Yes, it hurt. I'm still moving forward. I doubled down, got another coach, and where we failed, which was one of the failures, was capital raising. Got a capital raising coach. Next thing I know, 3 months later, I am now a capital raiser. I got invited on with some other friends I've known for a while who were experienced operators. And then I was on a deal. So a half failure deal to a full deal. And then, that got me into the races.
And as you started your journey, because, for the listeners, if you're not familiar, like there's a multitude of jobs, if you will, roles that you can do in a syndication, right? Like you can either raise money, you can find the deal, you can do all of that, you can bring, earnest money. And also this also depends on the size of the deal and everything, depending on how many partners you're going to need. But what role were you kind of interested in doing initially, and has that changed? Or is it an and not an or?
There's a lot of ands no matter what, but I would say my niche now is capital raising, and I fell into that. I didn't plan. My plan as an introverted engineer was to be more underwriting / due diligence inspections, especially if I was the guy, the boots on the ground. I could do the property management. And I enjoyed it because I like to build things, and I can, if I can build a big deck on my house, I have a good sense of what it takes to renovate and, general contracting stuff.
Yeah.
But that didn't pan out. Now here I am as a capital raiser. So as a W-2 worker working part-time as a syndicator, capital raising actually worked out really well because I could work nights and weekends.
Yep.
I didn't have to travel. Well, travel was very minimal. It's just something you can do at your desk. And it turns out I was good at it. And it turns out I quite like it. I mean, even as an introvert, I'm an extroverted introvert, so I love speaking with investors.
Yeah, and I think it's one of those things. I feel like I'm very similar in being an introvert, but if I'm around people that are talking about fun, cool things, I'm definitely willing to participate in the conversation. And when you start to get into the real estate game, it kind of becomes infectious, and you want to talk about it more and more. And so I guess how did that initial raise go for you? I don't care about the dollars, but asking or presenting deals to people, for me at least, I felt awkward, because nobody knew me as a real estate person. I've, like you had one career path, right? You were an aerospace engineer. I was in recruiting. Everybody knew me as a recruiter, not like this real estate person. So how did you kind of get over, that initial awkwardness or uncomfortability to go to people, whether you knew them or didn't, and say, hey, here's a deal that could be interesting for you if you want to invest?
God, it's super awkward, especially with no classic sales training. You just got to put in the reps. To be honest, there's no way about it other than to go into it. I would highly recommend, though, and I just did this at the beginning of the year. I went and got a sales coach, which was probably the most impactful thing I could have done, because I guess society has taught us what sales kind of looks and smells like. And if you take what society, you kind of get the used cars salesman type of thing. And it's just, and I didn't like that. So the way I approached it was, I'm going to educate. And that seemed to work, especially with engineers. Engineers really want to know the details and the numbers. So that worked for the most part. But once I educated myself on actual sales tactics that aren't salesy, and really understanding the mindset of what a potential investor is looking for, it's a total game changer.
Yeah. What are some of the things that you kind of shifted your approach because of this sales coach? I'm just kind of curious if what kind of tactics or methodologies, you don't need to give the secret sauce away, obviously, but anything that you can, because I'm always curious about how people are shifting their approach when it comes to capital raising or educating people on the market and all that.
I guess there's two things I can give you. One is understanding the DISC profile of people. Mm-hmm. Are they an introvert? Are they an engineer? All 4 DISC profiles have a different type of personality that you should understand, because like an engineer is very analytical. You're going to probably want to be more analytical. Some of the decision makers, like you think of a CEO, you got to give them an answer quick. Yep. They don't want to know the nitty gritty. Just get their trust, tell them what they want to know immediately, and move on. The second one, I had another good one to give.
It's like the DISC is. I've done the DISC profile many times in my life, but I can't remember what all the acronyms.
Yeah, I have a cheat sheet somewhere around here that I can't pull out quickly. But the other thing to talk to investors about is really understand their goals.
Yeah.
We love to what we call deal vomit. And it's just, we're so excited about these deals and these opportunities that we can just provide a great opportunity for people to come to. And we just geek out about it. And we know so much about the deal. We want to talk about the deal vomit, deal vomit, deal vomit. And that's not really what converts someone.
Yeah.
What will convert them is truly understanding their needs. What is their family's financial goals? Are they looking for cash flow? Why are they looking for cash flow? Do they really need cash flow? Where's their money coming from? Right? You got to kind of build up this level of comfort. Are they even the right investor for you?
Right.
Or
yeah,
are
I think it's a matter
you right
of,
for them?
Yeah, and I think it's a matter of there's some people that sell a deal. I'm very much let me present you with kind of why I think the deal is interesting. And if it fits into what you think you want to jump into, then that's great. Like I never want to feel like somebody is wiring money and they feel a little icky that I oversold them on something about the deal. That's just not my approach. And it sounds like you're more in that vein as well of just educating. I think that makes a ton of sense. And with are you currently still a W-2? Like, are you still in?
No.
So
I jumped ship from W-2 at the beginning of the year. I mean, it's questionably because 2023, the economy, investor sentiment this year has been challenging.
Yeah.
But I'm sticking to it. Yeah,
so
deals have come slowly, but
we're on a mindset kind of journey here a little bit. So I quit my job to start in my own recruiting business and also focus on real estate in January of 2020. We all know how 2020 went. Not a great time to start a recruiting business when nobody's hiring. You quit your job in the beginning of this year. And so I guess, how did you kind of make that decision? How did you and, the family kind of decide, okay, this was the date, or, how did you prepare yourself, for that jump?
Yeah.
You make a decision, right? It's not like, hey, I'm going to quit and then you don't do it.
Yeah. Aside from the economy, and I mean, even at that time, we weren't sure where the interest rates were going to go and where the economy was going to go, even in early January. The interest rates had gone up, but we didn't realize they'd continue to go up for another 6 months.
Right.
But based on how much effort I was putting in on nights and weekends, and based on the success I had in the previous year, there needed to be something that had to change in order for me to scale. And the only thing I could change to scale was dropping my day job because I needed to work full time. And I actually had a business coach who kind of helped me through the mindset of, is now the right time or not? And he basically said, Flint, if you were to go the next 12 months and say you didn't make your goal, where would you go after that? And I said, well, just get another job, I guess, doing what I'm doing. He's like, so your worst case scenario is where you're at right now. Yeah, I guess it is. Yeah. So, and at some point you got to think through, like, if you go 12 months and you're only 50% successful with what your goal initially was, would you quit? Like, no, 50% successful. The next year is going to be 150%.
Right.
So it's just kind of thinking through those things. And you got to put yourself in an uncomfortable position to get yourself in. I mean, in order to succeed, you have to be uncomfortable.
Yeah. I felt the same way, where I was like, well, I could just stay making good money as a W-2 employee, work my, butt off on the nights and weekends and try to make everything work. Right. Or I could take a leap of faith and bet on myself. And if it works, great. And I'll keep rolling. If it doesn't, I have, my wife and I set up ourselves. So if I had to make any money that the year I quit, like, we were not going to be, living on the streets or anything like that. So, you've got to set yourself up for success that way as well.
Yes. Yes.
It does take it feels weird when you wake up the day, after you leave and you're like, well, wait, I don't have to go to work. I have to motivate myself to do the things and, get out of bed on time and, all that stuff. But it sounds like you have utilized coaches very well to build your structure, so to speak, to kind of keep yourself kind of motivated and focused and moving in the right direction, it sounds like.
Yeah. And I think that's another thing that I learned out of this process is the best investment you can make is in yourself, and that's hiring coaches. There's a lot of people in our industry that, they don't bat an eye at $100,000 coach each year. I'm not at that financial level, but you can get an idea of the financial level of these people doing syndications that $100,000 a year is totally worth it.
Because they know that those coaches are going to 10x. They're going to get 10x return on that investment, right? Like that's just how they operate. And I actually recently got a business coach myself, and I've already started seeing success in just some of the things that I'm focused on and not focused on, and all that. It's definitely super helpful, and especially in the syndication game, if you're getting started, like joining a coaching program. There's a ton out there, but some of them have already built-in ecosystems of the team that you need to take down these big deals, right? Like you and I can't just go out and buy a 100-unit apartment complex if we've got no liquidity, no net worth, no track record. Like we're not going to get that deal done. You need to kind of find your tribe of people to actually, take these deals down. So let's talk a little more about your 1,500 unit portfolio. Where is it? What type of assets are there? Because it sounds like the first deal you went after was, a 23 unit, I think it was. And so, a smaller multi. So maybe talk a little bit high level about kind of your strategy and type of deals that you've been going after.
Yeah, at this point, I'm a little more agnostic to where.
Okay.
I think the most important part is with whom. So as I became a capital raiser, I like to tell my investors that if the only syndication group is doing value add in Dallas Fort Worth, that is the only investment you're doing is value add Dallas Fort Worth. However, those operators are experts in value add Dallas Fort Worth.
Yeah.
But you're not diversifying very much. And so I'm able to pre-vet operators, and a lot of these operators I've known for years. And I can bring them deals all across the country, including I did a fund to fund with 3 properties, 2 different states, 3 different cities, 2 different classes, class A and class B. So, I'm kind of all over the board on those. And then, build to rent. Now I'm doing a new development where we could build single family homes with the explicit purpose of keeping it a commercial real estate property. This is a mind shift here. They are single family homes, but the entire community is a commercial property.
They're all
managed. Yep. And it's managed with property managers. You have on-site maintenance. We just say it's like an apartment building, but your renters are in their own single family home.
That's right. Yeah. So I want to unpack that because I've seen, I live in Austin, and there's been a number of build to rent communities pop up for sale and also are being built, around the outskirts of Austin, just with the, sheer number of people that are moving here on a daily basis, it seems. So if I'm a multifamily syndicator, that's been my area of focus. And so I get the economics of a 150 unit apartment complex. Is it the same underwriting, the same kind of mindset because the 150 units are just scattered throughout, or how do you think about it as an underwriter and then a return profile? You getting these things as new developments that you're actually developing now? Or
we are building, we are developing.
So that's a majorly different kind of return.
It's majorly different.
Yeah.
But the end result is a community of, say, 150 people with your standard. So the end result is essentially the same underwriting, whereas the development side adds a whole new twist to it on the building and expense and new loan products. And you got to have a builder as part of your team members So there's a lot that goes on there. There's multiple phases. There's buying land and titles, permits, engineering, and then you get into infrastructure where you do utilities, roads, sidewalks, and then we do what we call vertical, where we start building the homes. So there's several phases in there, but in large part, build to rent for investors is a great asset class because there is so much institutional demand. Like the big BlackRock and Blackstone and all those guys, they really want to buy build to rent communities because they're so valuable, but they don't build. So this is where we come in. We can start building and we can syndicate, bring in investors that help us pay for the development. And then you're also buying something at a low cost, right? Land, and you're building things at cost, the houses, to ultimately create something that has a lot of value. So essentially your basis is low and your sale is high and you get a quick return on your money. So you could normally value add, you double your money in say 5 years. That's the golden standard that we go by. With build to rent, you can typically build a property quicker than that and sell it until you can double your money in less than that.
And I guess the only difference between a typical standard multifamily deal that's obviously already built is you're not going to be getting the cash flow from a development deal because there's no
correct,
right? So you're focused more on a shorter time frame with the same appreciation or maybe more appreciation. So instead of maybe doubling to your point in 5 years, you're doubling it in 3 or you're tripling it in 4 or something like that. So got it. So where are you? Have you done full cycle yet? Any of the build to rents, or where are they?
No, I haven't been in the game long enough. So right now there's 3 properties, 2 in Lafayette, Louisiana, 1 in Foley, Alabama. One's a small unit or a small property, 90 units. So I have 160 unit. Then the big one is 250. And then I'm now stepping into another group that will be doing Phoenix. So that's an opportunity I'm not going into details on, but if those out there who are interested, we will be marketing that deal pretty soon.
And are you typically doing 506C deals? So you got to be accredited to get into these things?
For the build to rent, they are 506C. I do 506B as well. So we'll take sophisticated investors. In large part, those will likely be a value add, not a BTR development.
Got it. Yeah, the build to rent is very fascinating because, to your point, you kind of have multiple exits, right? I guess you could theoretically and then operate it as a multifamily, and then eventually, is there stipulation? And I hate to get too deep here, but is there like stipulation that you can't just start to sell these houses off, or like is that a potential exit strategy where it's like, hey, we can't sell the whole portfolio or the whole property itself, so we're just going to start. The 150 deals, we're going to start listing houses.
Yeah. So I'll take this to both sides of the development. When you get into new development on an apartment building, you can't occupy the building until you get the certificate of occupancy from the engineer, and you have to be 100% complete. So if you build a giant building that holds 50 people, you can't occupy it. When you're building houses, they're all getting completed one after the other, and you can start leasing up. So technically you can start cash flowing sooner. We don't underwrite it. We're going to cash flow. It'll be cherry on the cake when we get there. And then you're right. The exit strategies, we have a lot of opportunities there. It does depend on whether your property is parceled in order to sell off individual houses. But yes, you can absolutely do that.
Got it. So if it is that one piece of land, then you'd have to go back and do it after the fact versus if it's already sectioned out individual, then it's easier just to say, yep, you're lot A and lot one and whatever. Got it.
Yep. So, I mean, plan A is to sell the entire thing as one big commercial unit.
Right.
Plan B, I would say sell off the properties to investors because you already have an infrastructure in place with on-site property management and maintenance. But if you need to start selling off houses, I would sell off like 5 at a time to investors. Hey, here's 5 brand new turnkey homes. And then you sell them off in big chunks. You have on-site management, and it's just kind of like this really great turnkey opportunity. And then I guess option C would be just sell them to individual home buyers and have an HOA.
Interesting. So we're recording this in kind of mid-ish September of 23. Obviously, we already talked a little bit about the environment that we're in, high interest rates and all that fun stuff. I guess, what are you seeing or what's your kind of game plan for this year and maybe 2024? Or it sounds like you're still fairly active. Are you, in buying mode or what is your kind of out or take on the market and what to do?
Yeah, I'm absolutely in buy mode. We closed on a 94 unit townhome community in May. But the deals coming through are not as prevalent. I've turned a couple down that I didn't necessarily like. I would say those didn't fit in my buy box. I didn't like the location. But yeah, I mean, if you think back in 2008, 2009, and even if you ask investors, if you had the opportunity to go back, would you start buying in 2009, 2010 on a discount? Yes, the interest rates are higher, but you get in on a discounted rate. And this is the opportunity. I mean, where history is slightly repeating itself. I wouldn't say 2008 is the same as now, but with the chance of getting discounted opportunities, it's there and the time is now.
Yeah. And because you're tied to a handful of operators, are you seeing or are you hearing from them that they're getting access to deals from kind of distressed sellers where, maybe they are on bridge debt with floating rate and they need to make a decision on if they're going to exit the deal, sell it, or they're going to try to do a capital call and raise more money from investors? Or what are you kind of hearing on that front?
Yeah, I think for the most part this year I've been focused on build to rent, so it's been more new dev. But the 94 unit community, it was just honestly the seller was like, "This is an asset. It's we were in Ohio, and most of their properties are somewhere else in Western U.S. They just they wanted to liquidate it because they didn't want to deal with it anymore." So you get all sorts of random cases like that. I've had a lot of friends who have gotten loan assumptions this year. So there's someone I think got one in Dallas or Houston at like 3.2%. It was a 300 unit. It was a monster of a property, and they got a 3.2% on it, which was cool.
Yeah, I've seen a lot of assumptions come out. That means you can kind of just take over the existing loan, and typically they're at 3-4%, and which is obviously much better than anything you're going to get right now, whether it's bridge or new fixed rate debt anyway. So yeah, I'm in the same camp. I feel like it is a little scary because some of the deals that I'm in are not doing as best as they could. So part of the conservative, risk averse side of me is like hoard cash. The other side of me is exactly like you said, this is the perfect moment. There is going to be a transition of wealth in the next, it's happening now already. You're seeing deals foreclosed, and, these big institutional buyers or even just other private equity firms that have a lot of cash to burn. They're going to go out and they're going to acquire these things pennies on the dollar and, make a lot of money. And so it's a matter of whoever has some cash that they can, invest in these deals, they're going to do, in my opinion, and I wish I had a glass ball. I would, or crystal ball, I would probably have prevented some of the stuff going on right now. But, it's definitely a buying opportunity, I think, to kind of get in now. So,
no, I hear you. And I think you aren't uncommon. I think it's more common that a lot of us have assets that aren't cash flowing. I mean, some of mine, we've held back on distributions because it is the smart decision. The property is in no way going to get foreclosed, but we aren't getting cash flow because it's smarter.
Yeah,
you're running a business.
Better to be safe than sorry. It's like, hey, do you want me to give you an 8% return and then lose the property in 6 months? Or how about we hold that return? It'll be accruing, and then, we'll at least keep the property and, everybody will be happy.
Yeah. And I mean, we're still adding value. That's what I tell. We're still appreciating because we're adding value. We're just not cash flowing.
No, I think it makes sense. A lot of the folks that listen to this are, either earlier in their real estate journey, or they are, W-2 workers like you were and had a steady career making good money. And they maybe want different options outside of the typical 401k or stock market. I guess, it sounds like you started with podcasts, and how do you think people should get started? They want to just, obviously they found this podcast, which is great, but like, what are some of the next steps that maybe you think people can take to continue to further their education and feel more comfortable, even being a passive investor, right? Because there's a lot of steps that you need to take to just feel comfortable giving somebody or investing, 50, 100 grand of your hard-earned money.
So the first step, and even for those wanting to go active, the biggest thing I have to say is take action. I listen to podcasts for so many months when looking back, I could have taken action much sooner, because especially as an engineer or even a perfectionist, you think that you've got to learn the next thing. You got to be an expert in all things. You got to know it all before you can move. And that's not the case. This is group investing. You got to rely on the team because the team makes it successful. So everyone is an expert in their own. Even as a passive investor, start talking to us. I mean, the thing that helps my investors the most is get on the phone with me, because I can get them a tailored education plan. And that just means, hey, it seems like you know this much already. Why don't you go read this book? And the number one book I tell people to go read is The Hands-Off Investor by Brian Burke.
Oh, okay.
It's literally just a book for passive investors, and to learn how syndications work and how to ask the right questions and what to look for when you're trying to vet a deal. But it will provide you the education you need to feel more comfortable and actually jumping into a deal.
Yeah, I think that's super important, because especially if you're passive, you're betting on the person that's bringing you the deal, whether that's a capital raiser and an asset manager like yourself, or the actual person that found the deal. So the passive investor is not going to necessarily dig into the underwriting, and yes, they'll obviously have questions, but you've got to feel comfortable with the person on the other side of the Zoom or the other side of the coffee table presenting the information.
Yes.
You've got to, especially if you're talking to a middle person, the person that didn't find the deal, you've got to trust them that they found somebody that they trust, right? So there's kind of 6 degrees of Kevin Bacon here, but you've got to kind of be able to ask the right questions and feel like you can and trust that person's going to be a steward of your capital, because that's effectively what we are. Is we're providing an opportunity for people to invest, but we need to make sure that we're doing our diligence to find the right deals as best we possibly can.
Yeah, and the only way to get that trust built up is to have more and more exposure with the actual operators. So get on the phone, see our emails, see how we communicate. Do you like us? Ask for past examples. I mean, all of that goes a very long way. I mean, I send past deal decks to investors just so they can wrap their head around what it is we present.
Yeah, I do that. I do. For every deal that I've worked on, I create a Zoom video of me walking through the deal deck and kind of getting a little bit more context to what each section is, and I send that whenever I have a deal. But also, if I talk to people that they're interested in getting involved, I send previous ones so they can see and hear some of the jargon, because also you got to educate yourself on some of the jargon and the terms. And then a lot of people will follow, but hey, what did this mean? Or can you show me this? And it just helps to have a visual about an actual deal that went down. So very, very cool. Well, Flint, I've taken up a lot of your time, and I really appreciate you taking the time to be on the podcast. I'm going to kind of transition to the end here. I've got a 3-pack of questions I ask every guest. So let's jump into that here. So question one is, what is one piece of advice that got you started or helped you along your real estate investing journey?
I think the number one thing is invest in yourself. So get a coach. That and take action. Take action before you think you need to take action.
I like it. You already mentioned a book, so maybe pick another one. But what's your favorite real estate or business book that you're into right now?
I always do. The book I'm reading at the moment. Actually, no, I'm going to rewind to a book a few books ago. The Extraordinary Mind is, I'm talking about mindset, because I always used to poo-poo mindset, but The Extraordinary Mind it's an incredible way to think about how our minds work and how you can better make yourself, make yourself more successful.
No, I like that. Yeah, I always balance between like business books and mindset books and all that.
Yeah.
I think that's super helpful. All right, final question. If you hit your financial freedom number, meaning you can live an amazing life off of the passive income from your investments, what would you do?
So my goal is to travel with my family. Travel is my life. If I could choose. I've been all 7 continents. I told my wife we weren't going to have kids until we visit all 7 continents. So mission accomplished. But yeah, there's just so much to learn and be exposed to. But beyond that, there's Engineers Without Borders. A lot of people hear about Doctors Without Borders. Engineers Without Borders is also a thing where you travel to different countries and you help build a water filtration system in Rwanda or something like that. And I just think that would be a really great way to give back.
That is fascinating. I had not heard about Engineers Without Borders, but I feel like that is a very needed skill set. I would have to imagine in some of these very rural countries that you can go in and provide some ability for people to, have a little bit more comfortability, to your point, getting, building wells and things like that. So that's interesting. I've never heard of that, but that's pretty cool. It's like a worthy cause to do when you're rich and you've got all your passive income flowing and you guys can travel and
and you still want to nerd out on engineering, design things. Yep.
Yeah, you're never going to lose that nerd out ability or interest, and so now you just have a little bit more time to do it because you'll not have to be working and being worried about where the money's coming in and all that fun stuff. So, very cool. Well, Flint, how can people reach out to you? What's the best way to learn about you and what you're doing, and if they're interested in maybe investing with you and all that, how do they get in touch with you?
Yeah, so my company is Vestas Capital, but if you want to find me, you can go to investwithflint.com and it'll take you right there. Or you can go to LinkedIn and it's just /Flint Jamison. I do a ton of content over there. You can engage with me.
Awesome. Very cool. Flint, really appreciate the time. It was great to have you on and really appreciate your story.
Yeah, thanks for having me, Justin.
I hope you got value out of this episode of the Work Hard, Invest Harder podcast. Your one-stop shop for education on how you can continue to work hard in your career and have different options to invest even harder. If you took anything away from this episode, please leave a written review. I read every review as it helps me serve you better. If you're listening to this podcast, it means that you want to grow your passive real estate portfolio. The easiest way to do that is to join our investor club by heading to greatventurecapital.com/invest. The link is in the show notes. See you on the next episode.